Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
Former President Ronald Reagan once had an aunt who took him to a cobbler for a new pair of shoes. The cobbler asked young Reagan, "Do you want square toes or round toes?" Unable to decide, Reagan didn't answer. So the cobbler gave him a few days. Several days later, the cobbler saw Reagan on the street and asked him again what kind of toes he wanted on his shoes. Reagan still couldn't decide. So the shoemaker replied, "Well, come by in a couple of days. Your shoes will be ready for you." When the future president did so, he found one square-toed and one round-toed shoe. "This would teach you never to let people make decisions for you," the cobbler said to his indecisive customer. "I learned right then and there," Reagan said later, "if you don't make your own decisions, someone else will." I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about good decisions versus outcomes. That story is an easy one because it was a bad decision and a bad outcome. He made the decision through indecision and learned from that. But a lot of times people make bad decisions and they get a decent or good outcome, right? You
Right.
bet on a bankrupt company. This is what a lot of people have done recently. And what ends up happening is the Fed pumps some money into markets, and then the company stock goes up, and then they issue new stock, bring in all this cash, and now the company's solvent again, right? You think about Hertz, or you think about GameStop, or you think about some of these companies. It was a foolish decision, unless you did it, with a tiny part of your money or whatever. But some people bet everything on that.
Right.
But it was a good outcome. And that's what we want to talk about today is how do you make good decisions?
That's a very important aspect of life, especially when people get to retirement times, because in retirement, there's new decisions that need to be made, right? Everything changes when it comes to retirement. Your schedule changes, your friends changes, your paycheck changes. So many things change. It's very emotional time. It can be for people. And it's very key to be able to have good decision-making skills to be able to move forward. And like the title of today's show, good decisions versus outcomes. Just because the outcome may have been good, that doesn't mean it's a good decision. And that's the point that we're trying to talk about today, is that you don't measure decisions by the outcome. You measure the decisions by the analysis done when the decision is made. And when people are talking about retirement, you have to look at a lot of different aspects. So, where's the best place to start with that, Daniel? The mind is a crazy thing, right? People need to be able to grow and need to be able to have a thought process to be able to have a process to be able to remain relevant, be able to grow, right? And that's part of the decision-making process is how relevant things are.
Right. Well, I think that's why that story with President Reagan is so important. And it may sound like a silly thing, but this is something that happens quite often, is where people make the decision by indecision. Well, why do you do that? Well, did anybody help Reagan go through, which was going to work out better for him, the square or the round, right? Maybe he didn't even know where to start. He didn't know what he didn't know, right? He didn't know where to start in making that decision. And so what it goes back to is what tools do you have to help you make the decision? Or do you want someone to help you make that decision, right? So when we talk about finance, there's two ways you could look at it. You could make the decision to pick a decision maker for you to help you pick the investments in your account, but you still have to judge and make sure that person is taking the education and they are a good decision maker. They are learning and growing as things in the world change so that they can help you. Or you want to put the time and effort into that in order to help you have the tools you need to do the deep dive and the analysis to see all options and scenarios, or at least what's possible, in order to make that decision. Because if you don't have all the facts, or you're just basing off of what has happened in history and not what different outcomes could be, then you're not making a good decision because you're basing it off of one thing. And if you have a good outcome, you have a result that you like, you're happy, but that doesn't mean you made a good decision.
Right. Exactly. And, knowing, the key points that, the takeaways there that I got from what you just said is, one of the big things is when people don't know what people don't know, and they don't know what questions to ask, and they don't have somebody to help them walk through the decisions, it's very difficult to make a decision. Ronald Reagan, that story about the shoes, he didn't know what he didn't know how to figure it out. And then, there's the other end of things when people get analysis paralysis because they analyze things so much, but that still is questionable on that front. But that's where, I think that when we're talking to, on the show today, which is Financial Strategies with Andrew and Daniel Agemy, and the title of today's show is Good Decisions versus Outcomes. And, the commission report that I would like to give away today to anybody that wants it is right and wrong ways to invest. Right and wrong ways to invest to be able to help you understand what you don't know. And you can have that by calling us at 800-725-7616, 800-725-7616. Daniel, when people, and that's what the show is all about. People don't know what people don't know. And sometimes just the whole thought process can help people ask good questions to give them information that they can ask more good questions to be able to come up with an analysis of certain things. And the better you are in asking questions means the better the answers are going to be.
Yeah. So basically what it starts with is paradigms, right? Everyone has a paradigm of the world based on their brain's past experiences. And that's how we make decisions. But things change, right? Environments change, governments change, market structure changes. These things change. So if we go back in time, and let's say you're at your retirement age, we go back in time, you have had one of the absolute best times to be in the stock market.
Right.
What's happened is baby boomers, right, came into the workforce, and they changed the way the world kind of ran. They have taken over the world. They kind of run the world right now. But what happened is they slowly built that up, right? And they started making money, and they started participating in different types of technology and these kinds of things. And
401k plans and such. Yeah,
right.
Exactly.
401ks.
Yeah.
Were created, right?
Yep.
And so money started coming out of their paychecks. They started having extra disposable income as the U.S. innovated and really pushed the internet, right? Developed the internet, developed these huge companies, right? We have Apple, Facebook, Amazon, and they were able to participate in all these things and take money out of their paychecks and put it into markets.
And Daniel, let me just add this point with that. It's very interesting because with the baby boomers as well, prior to the Greatest Generation, really, women didn't work outside of the home. And then with the Greatest Generation, with World War II, women had to go to work. And so now they got two incomes, which was a big deal. But then when baby boomers hit the scene, now we have, dinks, double income, no kids, right? And so they're both working, they're making good salaries, they don't have expenses like their parents had from that. So now they have more disposable income and they're making them more money than anybody has ever made before. And a lot of that's going into the market. So there's a lot of, and plus what were they doing? They were, 30, 40 years ago, baby boomers, they were buying houses, buying cars, raising kids, spending money. And now baby boomers are not spending the money that the way that they were back then. And I think you're going to go further with that. So I just wanted to add that aspect to this. Yeah. So there's a lot of stuff happening.
That's absolutely true. So there is all of these factors that were contributing to trillions and trillions and trillions of dollars going into U.S. markets, right? And as that capital flows into markets and markets started growing, especially after the last 2 decades, international money started coming into the U.S. markets as well. And it starts pushing these things up higher and higher and higher. And people are participating and doing very well. And it's adjusting their paradigms. It's adjusting the way that they view the world. And it's giving that I'm making good decisions. I'm making good decisions. And they probably were good decisions, right? Putting money in your 401k because you see this very often, right?
Yeah.
A lot of boomers, a lot of retired age people have significant wealth.
Yeah.
Because they bought a house or they bought a couple of houses and those have appreciated tremendously. They put money into their 401ks and that appreciated tremendously. And then you see other ones who had the same opportunities, but they didn't participate in their 401k or they didn't buy the house.
Right.
And now they have very small assets because the way you grow your money, the way you grow your wealth, which people have realized is by wisely investing it, right? And you don't get any money if you just put it in the bank or you didn't buy the house or you didn't participate in your 401k. And now they don't have any assets. So they were good decisions, but you may need to reevaluate based upon what's going on currently.
Right. Yeah. Just because you made good decisions in the past, you can't make those same decisions going into the future because everything has changed. Paradigms have changed and paradigms change both in our culture, in the world, as well as for individuals, or they should. And if you as an individual are keeping your paradigm the same when everything else is changing around you, that's not going to have the same results. And just because an outcome might be good, that doesn't necessarily mean that you made a good decision. Well, you've been listening and you are listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is good decisions versus outcomes. We have a book that we'd like to give you. This is not a financial book because today's show is primarily about thinking. Today's show is primarily about making decisions and helping people be kind of holistic in their retirement planning and whatnot. So we have the book called Think Again. Think Again. We'd love to be able to give that book out to you. It's by Adam Grant. It's not a financial book, but it's about being able to think and be able to help you in your decision-making processes. If you like that book, you can call us at 800-7616, and we'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So I know none of our listening audience would do this. So don't picture yourself doing this because I know you would never do this. It's your neighbor Joe. Okay. So your neighbor Joe likes to go out and your neighbor Joe likes to have a good time. So he goes downtown and he has a few drinks, not too many drinks, just, 3 or 4 drinks. And he decides he doesn't want to pay to get an Uber home, or he doesn't want to pay for overnight parking. So he's gonna drive home. He just had a few, and he's gonna drive home. So he drives home and he makes it, and everything's good. So there was a favorable outcome. He didn't get a ticket. He didn't hit anybody, and he didn't have to pay for parking or an Uber. So good decision, right? No, horrible decision. He didn't weigh out all the consequences. And just because it was a decent outcome does not mean he made a wise decision. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies. And you're Daniel Agemy. Today's topic, good decisions versus outcome. Daniel, that's a great example of that's a good outcome, is that there was, like you said, didn't have to spend any money, didn't hurt anybody, got home okay, but it was not a good decision. It was not a wise decision. Didn't analyze the things properly. And of course, you're not going to be able to analyze things properly in that kind of stupor. But that's what we want people in our listening audience to be able to be aware of, that to be able to make decisions on purpose instead of making a decision by indecision, be able to ask the right questions, to be able to get the right outcomes, get good outcomes. And, you had talked about earlier the aspect of paradigms and talked about the paradigm of the baby boomers putting a lot of money in the market. The markets have gone up. Just because the baby boomers put a lot of money in the market and the market's gone up, does that mean the market's going to continue to go up?
Well, let's go back to Joe, right? Joe did that one night, and he is a little scared, right? He was like, "Oh, I might get pulled over, whatever." But he made it, and so now he made a good decision. He drove home drunk, and he made a good decision because it was a good outcome. So he does it again, right? And then pretty soon, he's doing it a few times, and pretty soon that's his MO. He doesn't even think about it anymore because he's done it 25 times. And he's never got pulled over, never had an accident. He actually is a better driver driving drunk, right?
Right.
And he does this for 2 years, and then 3 years, and then 4 years. And now there's not even a thought. It's just, I do this, right? And he's starting to build this paradigm of decent outcome equals good decision. And it's still a bad decision. But what he has to do is that's why we're giving out that book, right? We're giving out that book of Think Again, because you get into these traps, these paradigm traps like Joe, where he's done it so many times and it's just automatic. He doesn't weigh the consequences. But if he stopped and he said, okay, I'm saving $20 because I'm not taking an Uber home. And he doesn't weigh out, well, I could kill somebody by driving home drunk. Let's weigh that out. $20. You multiply that, he goes out a lot. Multiply that by however many times you want a year versus killing somebody because you were driving drunk. You don't think that's realistic? Okay. Well, what about you get pulled over and you lose your job? Right. Or you have to pay $10,000 or $20,000 in attorney fees?
Right.
This is what we're talking about when we're talking about not just basing your decisions off your past experiences, but actually diving into the facts, the outcomes that could happen and that are probable to happen. I mean, this has taken the whole moral thing out of it because obviously that's not even a moral decision to make. But weighing consequences, right? You have to look at that. And so when you're talking about the market structure and you see what's happened as this one of the biggest generations, wealthiest generations, has been taking all this money, putting it into markets, driving markets up. And now they're all kind of starting to retire.
Right.
So what does that mean? Well, that means flows. And that's where it's passive flows where you've been saving. I don't know, how much money do people, a lot of people are maxing out their 401ks now, right? So if you have these boomers, especially, who have been saving and they're maxing out 401ks, this is passive money coming into markets, driving markets up.
Right.
Well, as they retire, what's going to happen? Not only are those flows going to stop, and who's going to replace all those flows? Because you could say millennials, but they don't make as much money as the boomers make. Right.
Exactly.
Also,
Yeah.
they might not be as interested because they've already seen some nasty stuff in markets. They don't have the same experiences. Right.
Right. Right.
So they're more interested in maybe multifamily houses or cryptocurrencies or these
Right.
kinds of things. So they may not be as interested in giving their money to BlackRock to manage.
Right.
Or whoever that is. So now you have money not going into markets at the same time as people retiring. That means what? They're going to take money out of markets.
Right.
And I've heard lots of times investors say, well, I have enough income. I have a pension, so I'm not going to be taking money out of my accounts.
Right.
Well, what do you think the pension's doing? The pension's not generating enough income to pay you that.
Right.
Right? If they're 60-40 and the bonds are generating like 1.25%, 1.5% of income, they're selling equities.
Yeah.
So you are taking money out of markets.
Yeah. Exactly. That's exactly right. And that's why, it's a different thing. And baby boomers, when they're taken out, they may also be, a lot of what we see is that they're taking it out of the stock market and put it into the fixed income market so that they can get income from it. And if you just started to listen to us, you listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is good decisions versus outcomes. We have a nice checklist for you, right and wrong ways to invest for income and to invest. And this is a great opportunity to be able to help you think through and make a decision on purpose rather than by indecision. So get the commission report, right and wrong ways of investing, calling 800-725-7616. Daniel, that's a great topic. These flows of money, when they start, the millennials, like you said, they don't make as much necessarily as baby boomers making, but the types of investments, things that are going to go in, can be a whole other situation. Doesn't mean that they won't be in the market at all, but it may not be what it was. And it's kind of interesting because if we look at the stock market today, and basically it's kind of gone sideways in the past, 4 or 5 months or so from that angle. And, and what's it going to do? I mean, it can continue, it can go up, but people can't do things the same way they always done. The paradigm shifts when you get to retirement. And when this is happening, the baby boomers are going to go to maybe getting income. They have to take RMDs, so they have to take money out for that. Now, some of them will reinvest it, but some of them will spend it. They'll give it to their grandkids, or they'll give it to their kids, or whatever the case may be, because they want to see the kids enjoy it while they're alive. So that's can result in that. So that's why we have to look at things differently going to the future. We have to think this through.
Right. So maybe we should explain how a market works just real quick, because I want this to be super clear. And maybe some people will be like, that's basic. And maybe some people just want to know this so this can make sense what we're talking about flows. Because the way a market works, right, is you own something. So you're part owner of a company.
Right.
And so I say to you, well, I think that's going to be worth more in the future. So can I buy that from you? And you say, well, I think it's going to be worth more in the future. So you can, but you have to pay me. I paid $10. You have to pay me $20 for it. And then I say, okay. And this is happening, every millisecond, right? Things are ever trading back and forth, back and forth, back and forth. Sometimes people think when they buy a stock, the company is getting their money. And that only happens on an initial public offering, right? But what it's really happening is we're trading these stocks back and forth to each other. We look at the company and we decide this company has value, and I think they will be more valuable in the future, or they're going to pay me something, right? I'm going to give them this money and they're going to give me a stream of income So I'm okay if they're not going up because I'm getting paid to wait, right?
Right.
And then we trade back and forth, and that's how markets work. So what's happening with passive flows is that your money's coming out of your paycheck, and either you're giving it to a money manager like BlackRock, who may be doing like a target date fund, or it's going into something like an S&P or an index, right? The Russell or something like that, small caps, and it's just going in there, and no one's looking at the companies they're buying. We call it dumb money, right? Because nobody's saying this company's future earning potential is three multiples from here, but yet it's trading at 27 or 40 multiple, right? You're not really going to get your money back. So nobody's looking at that because it's just passive. It's just the 500 companies in the S&P 500, and all the 401k money's just going into that. So as long as that keeps happening, what's going to happen?
Going to go up.
It'll keep going up, right?
Yeah.
But if more people are taking money out of the S&P 500 because they have to take RMDs, like you mentioned, or because they're not contributing to their 401k anymore, or because their pension plan is selling stocks to generate the income that you need to get that pension check.
Yeah.
Right.
Yeah.
Or people are passing away and their stocks are being sold to go to the beneficiaries because the beneficiaries want to buy a house, or the beneficiaries want to invest in crypto or the metaverse or some of these kind of crazy new things that are happening. Then the flows aren't coming in there, and you only have what? People who are doing the valuations and saying, I think that's too expensive. I'm not going to put my money in there.
Right.
And then you have the potential for these things to come down.
Yeah. Yeah. And that can be disastrous to somebody's retirement. That's one of the various ways that people can run out of money in retirement, which is what is not wanted. Certainly unwanted situation. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. We're going to need to take a break here. We're going to come back and talk more about today's topic, good decisions versus outcomes. We have a book that we'd like to put in your hand if you're so inclined, if you're a book reader, and this is called Think Again. It's not a financial book, but it's a book about thinking, and how you think can determine what kind of decisions you're going to make, and what decisions you make can determine what kind of results you get as far as your retirement goes, as far as your investments go. So we'd like to put that in your hand. You can have that book by calling us now, 800-725-7616. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So in Connecticut, we have at least what used to be the two of the largest casinos in the world. And so Joe decides that he's going to go to the casino, and then he decides that he's going to only use $1,000 to be able to gamble at the casino. And as he goes to the casino, and he does quite well that night, and he ends up getting, and that turns that $1,000 into $10,000. So you might say, hey, he made a good decision to go to the casino. He made a good decision to take the $1,000, made good decisions on how to gamble that money. Well, did he? Is that true? Well, there's more decisions to be made after this. What does he do with the $10,000? Does he just say, okay, and takes his money and walks away and goes home? Does he take it and continue to gamble it to try to turn his $10,000 into $100,000 and 10 times it again? Well, that's the rest of the story. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about good decisions versus outcomes. And that story, it sounds like Joe gets his way around, drink, drunk, driving, gambling, all the good stuff. that story, that's a good point, because a lot of people have done well gambling, and that's a decision, right? That's a decision. What do you do now? Do you keep gambling, or do you do something else? And you have to use that checklist, right? In order to help you make those decisions. You have to switch that paradigm. And that's what we're trying to explain here is the different outcomes that you need to weigh before you decide what you're going to do. Instead of just saying, well, this has worked in the past, you have to keep evaluating that. And there's quite a few Wall Street people, some of the big short people, some of the people, they've made like, $400 million on a trade or on a gamble, right?
Right.
And they don't put the money back in the market. You know what they do typically? They get out of Wall Street. They go buy a vineyard, a wine vineyard somewhere, and they buy apartment buildings somewhere else, and they buy a farm somewhere else, and they buy income producing assets.
They changed their paradigm.
Yep. Because now they don't have to gamble anymore. And they realize that now, I don't know if there's anybody listening who has $400 million, but that's beside the point how much money it is, because it's the same thing. If you've done well, it's time to look at how you're investing, the decisions you're making, and why you're making those decisions.
Right.
Why are you doing the same thing you've done? Or is it time to switch like these, multimillionaires or these people who have made a ton of money? They don't want to lose it. That's all they want to protect it from inflation, and they don't want to lose it because they don't want to be back where they were. So they buy these things that they know over time have done well, and then they diversify across regions and countries. And then what do? They buy things that will generate income. So even if they don't do what they've done in the past as far as appreciation, it doesn't matter.
Right.
Because they have the income they need to keep the lifestyles that they want to have.
Exactly. If you don't have to make a lot of money if you're consistently always making money, and you'll be ahead of the game in the long run from that standpoint. But so many times people say, well, I have to make money, and they make a decision based upon that, thinking that the outcome will be good, but it could be just the opposite. If people say, well, I have to invest aggressively, and it's 2000 and 2007, I have to invest aggressively because I want to be able to retire in just a couple years, and they invest aggressively, and then the market drops, and that was not a good decision. But if they invested in 2000 in that, and the market dropped, and then it came back up again, well, hey, that might be, they think that's a good decision. But the question is, you have to look at and analyze what are the various outcomes. Go through and run through the scenarios. Well, this could happen, or this could happen, or this could happen. And a good decision is not based upon the outcome. A good decision is based upon the analysis for being able to get yourself through the situations safely, as far as retirement goes, safely, not being able to, be able to have the money that you need now and throughout retirement, so that you don't run out of money. Right.
Right. And that, I think that's a good scenario we could actually look at with what you just said about the market in 2007. Right. So the housing market was in a bubble, we found out, right. And the financial markets were bubbly, and the structure was off. So when the housing market bubble popped, it brought down markets too. So if you were retirement age and you were like, well, markets have done really good, and they always go up, so I'm going to put my money into the market, you made a bad decision and you had a bad outcome.
Right.
If you were same situation, but you're 18 years old and you say, I'm saving $200 a month, and I want diversification. I don't have a lot of money. I want to own 500 stocks, so I'm going to buy the S&P 500. And you bought it the same day and it crashed. You have to reevaluate, right? Because now you just lost half of your money. It was only $400, whatever. You haven't saved a lot yet. But now you're reevaluating it. Well, I made this decision because I'm going to continue to save money, and I want this diversification, this cheap, easy diversification.
Right.
I looked at that decision. I'm going to keep with my decision because I'm going to be saving for the next 40 years.
Right.
Right. And this may just be a blimp on the screen. Right. I want to have this diversification. I think that these 500 companies over the next whatever years will be okay. And you keep doing that. Okay. That was a good decision. And today, now you see there was a good outcome, right? Because you were able to buy lower. And then as it went up, keep buying. So the outcome, right? The reasons you're making the decision, looking at all the different scenarios and the outcomes for the purpose that you need has so much to do with that. So you have to see the purpose, what the goal is as well. And that's what these people, like we just talked about, who made this huge amount of money, they're looking at their purpose. They don't need to make any more money, but they don't want to lose it. They don't want to be in that situation where they were before they made the money.
Exactly. And what they have there, they change their paradigm from a performance standpoint and strategy, making that money. Now that they made it, they want to change to a purpose standpoint to be able to keep the money, hang on to it, and give them the income that they need for the rest of their life. And, if you just started listening to us, you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And we're trying to educate people to be able to help them to be able to make smart decisions, give them information that they don't know, teach them some things that you may not even know, or at least help you have to be able to ask the right questions to be able to get there. And with that, we have a paper that we'd like to put in your hand that's going to be able to help you make the right decision, help a checklist that will be able to help you to choose the right financial advisor,
or
right
ask
person.
The proper questions, right? Because
Yes.
that's what you started out with the beginning is you have to be able to make those decisions. But if you don't know what to ask, how are you going to make a good decision?
Right. Exactly. If you like that paper on choosing financial advisor, somebody that can help you think through the financial side of things, call 800-725-7616. We'll be glad to get that out to you ASAP. 800-725-7616. Daniel, shifting of the paradigm, the analyzing and going through the different scenarios of what could happen on the outcome. When we're talking about that, I'm thinking that, I'm looking to buy a new car, and I'm going through, I'm looking at this one particular brand, and the salesperson there, I'm driving her crazy in my analysis with this situation, because I'm trying to get the right outcome so that to make a good decision, that I can feel good about the decision. Then as far as the outcomes go, that's going to be a good outcome. And so that analysis is important. But one of the things that gets people in trouble is analysis paralysis. They spend so much time analyzing things and vacillating back and forth because they don't know what they don't know. They don't know the right questions to ask. They don't know, who to ask, right? I mean, there's the great proverb that says there's wisdom in an abundance of counselors. So be able to get some, and that doesn't mean that any one person's going to have the answer, but you're going to hear all these things and be able to filter that through the funnel of the analysis to be able to come out with something that will be able to help you in regard to making a good decision in that. And some people also say to me, "Oh, I'm not going to be able to make good decisions with that." And what I say is, I'm going to help you all the way along the way. I'm going to hold your hand. I'm going to be at guardrails to keep you from falling off that cliff, so to speak, and keep you on the right road to a good decision.
Right. Well, that's the educational process that we like to use. And what happens is people just make decisions, and some people know, like, I've got this knowledge base that I can pull from, and I can make a good decision. And they're constantly expanding that knowledge base and keeping that knowledge base relevant. And they can collect that information, like you said, abundance of counsels, and then make a good decision. Because they've built up this knowledge and they know they have the ability to do that, and they have that confidence. And some people may have that in one area, but not another. And they say, well, if I'm over here in the medical world, I can make all the best decisions. But if I'm in the financial world, I need to sub that out to someone who knows how to make good decisions over there. And both of those answers is fine, as long as you are weighing all the costs, the risks, and the rewards, right? The different outcomes. We've talked a bunch of times about how you have to look at not just best case scenario to make your decision, right? Well, if I make it home, then I don't have to. Then I'm scot free, and I didn't have to pay for a taxi. But like, that's best case. But what about getting pulled over and getting a ticket? That's more than that taxi. What about getting pulled over and getting a DUI and not having a job? That's even more, right? What about killing somebody? So you have to look at all the different scenarios. You can't just base it off of one scenario. And that's where good decision making comes in. It may not be the best outcome. Like if you made it home driving drunk and it cost you nothing, but you paid $60 for an Uber ride because you live a long way away. Well, you feel like you made a bad decision because it cost you $60, but it was still the right choice, right? Because you have to weigh all scenarios.
Exactly. When it comes to people's retirement and how they invest their money, that's especially important because the worst case scenarios could make it mean that you're eating cat food at some point. And so with that, we'd like to put a book in your hand called Think Again. It's not a financial book, but it's a book to be able to help you write, to ask the right questions, to be able to think through, to be able to form a process for how to stay relevant in life. We'd love to put that in your hand by calling 800-725-7616. You can have that for free. You're listening to Financial Strategies with Andrew and Daniel Agemy. Good decisions versus outcomes. We'll be back with more after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
And as you know, we are always trying to hire the best possible people to help take care of our clients. And as we're growing, we're hiring people. We're hiring right now. So I'm going to give people a little leg up on our interview process. When we're interviewing people, one of the questions that I like to ask is, with the world changing so quickly, and it seems like it changes faster and faster every day, how do you remain relevant? How do you keep up, and how do you stay not only educated, but continuously educate yourself? And some people have great answers, and some people don't maybe understand the question, and some people are just dumbfounded. And one of the best ways to do that, right, is filtering out the noise, because things seem like they're always moving fast, but when you filter out the noise, you get a great picture. I'm Daniel Agemy.
And I'm Andrew Agemy, and you're listening to Financial Strategies. Today's topic, good decisions versus outcomes. Daniel, filtering out the noise is an important thing, right? There's a lot of talking heads out there, a lot of just different things going on. You know, tell us more about this filtering out this noise aspect and how that's relevant, how that's pertinent to people here.
So we talk about building up your knowledge base, right?
Right.
The better knowledge base you have, then you can change paradigms. Because if you don't change the knowledge that you have, you can't change your paradigm, right? Your paradigms are based on your brain's past experiences. So you can give them new experiences by reading and learning from other people's experience.
Right.
If you just only make decisions off of what you know, that's a very difficult thing to do because you're getting a lot of noise, right?
Yeah.
The talking heads, like you said, everyone freaking out about this or that or the other thing on social media platforms or newspapers or wherever you get your information from. And it makes it seem like things are moving faster than they actually are. And
then if you don't even know what you don't know, how can you draw upon your own experience? Because there's all this information that you don't even know that you don't know. So, that's crazy.
Right. And so we think we're in different times than we were at any time because of technology and because of all these things. But we're not.
Right.
If you go back and you read 100-plus-year-old books, they were going through the exact same things. They still had technologies that were changing and changing the way everything was done. But do you know what happens when you read the older things? It
The
filters out the
noise.
noise.
Yeah.
And now you can get perspective. That's what a lot of people tried to do with the pandemic, right? They didn't. It was so much noise and no one knew what was happening. And some people, they went back and looked at what happened when we had pandemics in the past to try to make better decisions
Or this one.
today with all this
Yeah.
stuff when people were freaking out, right? To help them make better decisions. And so you can, even though it doesn't make sense. If I look at ancient history, if I look at 100 years ago plus, it's going to help me make better decisions today. And maybe it does. Maybe that does. I guess it depends what stage you are. If you were already doing this, then you're like, of course it makes sense. But if you hadn't, if that hadn't crossed your mind, then you're like, wow, yeah. And so are you going to be the one to do that? Or are you going to pick someone to help you do that? Right.
Right.
And so a lot of people sub out their stuff to like maybe a broker dealer, right? Or someone that works for one of these big firms, like, I don't know, maybe like an Edward Jones or a Morgan Stanley, right? Where they have a salesperson, right? And they're just getting research because they don't want to be the one who's putting in all the hours to help their clients make the decisions. What happens? And you know this because you were here at one point in time. I know this because I was here at one point in time, right?
Right.
They want to go. They want to be in time for their kids' soccer game. So you can't fault them for that. That's an amazing thing.
Right.
But they pick simplicity. I'm going to get the research handed down to me, or I'm going to listen to the CNNs or the CNNBCs of the world, the Jim Cramers of the world, and then pass that information on instead of filtering out the noise and doing the deep dives themselves, spending all the time and money to get themselves educated and continually educated so that they can help make those proper decisions or help their clients make those proper decisions.
Exactly, Daniel. That's why sometimes when people drive by our building, they'll see the lights on at 7:00 at night and whatnot, because we're doing research, we're doing stuff to be able to put us in a better position to be able to help clients, and because it's a thought process and having the hands on, and that's where the importance comes in with an independent registered investment advisor, for instance, because that's their responsibility to make sure that they're doing what's in the client's best interest. And some of these other companies that, even though they might say they're a fiduciary, the question is, who are they really ultimately a fiduciary for? And most of the time it's stockholders. But these are good things that you're bringing up. And that's where we have a paper for you who are maybe just turned in. You listen to Financial Strategies, and today's topic is good decisions versus outcomes. And we have a checklist that you can use when looking for somebody to be able to help you with financial decisions and financial counseling and advising from that standpoint. And you can have that by calling us at 800-725-7616, the checklist for choosing a financial advisor. 800-725-7616. So Daniel, we just have a few minutes left now in our show. And, this topic of making sure that, an independent advisor who is taking the time to study and taking the time to put effort in helping people to make the right decisions, as opposed to just selling them a product or whatever. How does that fit into play for these people in our listening audience?
Well, that's where that checklist that we gave out comes into big play, because it gives people questions that they may not have thought about, and it helps people run through the decision-making process and visualize, right? Oh, I need to ask this. I need to ask that. I need to ask this. And that's what this show is about. We're not asking anybody to hire us. Like, we don't, we have the best clients in the world. And so we're not doing that, but we're so blessed, and we've already been able to go through this process, right? You started out with a huge insurance company, money manager, and you did what they said and you sold what they told you to do. And then as you built up your knowledge base and your decision-making powers, you realize, okay, you know, they're not bad people, but they're not doing what's best for the client.
Ultimately for the client, right.
And I don't have the tools available to really serve my clients best. So what did you moved, you dropped them and you went to a nice independent broker dealer and you were with them for a while, right? And you said, this is a lot better. I can do what's in the best interest of the clients. I have a lot more freedom. And you did that for a while until you realized, well, the broker dealer was still looking out for number one, them, and number two, the client. Right. And so even though it was multiples better than where you were, because you had so much more available for your clients and freedom, it still wasn't, the client wasn't number one. So we went and we started a independent investment advisor where the client's number one. There's not stockholders. You just focus for them. And then as that grew and got better and the knowledge base got better and better and better, you started this show so that we could add value, hopefully, and help people understand these things that they don't know so that they can either advise their advisor, ask their questions, make their advisors think. If their advisors are not independent and their advisors are just getting what's passed down to them from the market analyst or from the their supervisors or wherever they get that information from, because they're with those because it's easy, right? They pay for half of your salary, your staff salary. They pay for half of your office, right? They help you hire people. They do these things. They give you market research. So you just show up, sell some stuff, and leave. And it's another decision. You have to make the decision as the investor, as the retiree. Is that what your person's doing? And they're just passing something they heard on to you, or are they diving down deep? And doing what's in your best interest?
Exactly. And are they holistic? That's exactly right, Danner. That's all that stuff is, what we're trying to do is be able to help people, educate people. That's why we give out these books. These books cost us money for the time to send them to people. This radio show costs us money. Our major goal is to educate people so they can make smart decisions. We want to serve people. And we know that when we serve people, the rest will be taken care of. We'll be taken care of. That's how we've done this for over 30 years now. And that's how we'll continue. That part of the paradigm stays the same because those are old, tried and true, historical things that work over time. You reap what you sow. And with this, we're always staying on top of these things to be able to make the right decisions and help people to make the right decisions, help them along the way to be able to do that. So, the outcome is not as important as the decision. If you make the right decision properly, you'll get a good outcome no matter what. And that's what we're concerned for you and our listening audience today. Well, it's been great being with you today. And we have this book that we'd like to put in your hand to help you think through these things and to be able to help you to grow and be able to understand what questions to ask. And this is called Think Again by Adam Grant. It's not a financial book, but a book that will be able to help you to be able to think and get better off with your finances with that. And you can have that by calling us at 800-725-7616. No charge, 800-725-7616. Well, with that, we are looking forward to being able to talk to you again. And we want you to know in our listening audience that you too can have a stress-free retirement.